Wednesday afternoon. The United States government called an emergency meeting on critical minerals 72 hours after silver's collapse. One agenda item, marked classified. JP Morgan's derivatives desk went silent for 48 hours, and someone with treasury-level intelligence bought 127 million ounces during the panic. While retail investors were selling in fear, the question is not why silver crashed. The question is, what do they know about what comes next? Welcome to John Analyst. Now, before we go any further, if you've been around long enough to remember when news came from newspapers instead of notifications, when financial intelligence required patience, not just a scroll, then you understand the value of information that actually matters. Do me a favor. The way you might ask an old friend for their honest opinion over coffee, click that subscribe button, not because of algorithms or trends, but because what we discuss here is the kind of analysis you won't find in 30-second clips or sensational headlines. And one more thing, drop a comment below and tell us, where in the world are you watching this from? London, New York, Mumbai, Singapore? Because what's happening in silver markets right now, it doesn't respect borders, and neither should the people trying to understand it. Now, let's get into what's really happening. On a cold Wednesday morning in February 2026, something unusual happened in Washington, D.C. The Department of Commerce sent out a notification, an urgent interagency meeting on critical minerals. Attendance required, no press coverage. The timing was curious. Just 72 hours earlier, silver had experienced one of the most violent price dislocations in modern financial history, a crisis that erased billions of dollars in a matter of days. Margin calls cascaded through trading desks from Shanghai to New York. And yet, while retail investors watched their portfolios bleed red, while financial media declared precious metals dead, the United States government was quietly assembling experts to discuss the very commodity that had just crashed. Why? Anyone who has spent time studying markets knows this truth. Governments do not move quickly without reason. They do not convene urgent meetings about commodities unless something deeper is happening, something the public is not seeing, and they certainly do not discuss critical minerals. The same week, those minerals suffer catastrophic price destruction, unless they know something. The meeting agenda was brief: strategic assessment of critical mineral supply chains, national security implications of commodity volatility, industrial preparedness and resource allocation. One item was marked classified. But here is what made experienced analysts stop and take notice. JP Morgan's name appeared in preliminary briefing documents, not as a participant, but as a case study. The largest commercial bank in America, an institution with more than $2 trillion in assets, was being discussed in a government meeting about silver, the same silver that had just crashed. The same silver where JP Morgan held positions so large they had triggered regulatory investigations in the past. To understand why this matters, one must understand what silver actually is. It is not just a shiny metal. It is not just an investment vehicle for speculators. Silver is a strategic resource. Every missile guidance system contains silver. Every solar panel requires silver. Every smartphone, every electric vehicle, every 5G tower, silver. The United States military cannot function without it. The renewable energy transition cannot happen without it. Modern technology cannot advance without it. And here is the uncomfortable reality. America does not produce enough silver to meet its own needs, not even close. The country imports more than 70% of its silver consumption from Mexico, from Peru, from China. When silver's price becomes unstable, it is not just investors who suffer. It is defense contractors who cannot secure materials. It is technology companies who cannot plan production. It is government agencies who cannot guarantee supply chains. This is why the meeting mattered. But there was another layer. JP Morgan. For more than a decade, researchers had documented something strange. While the bank's traders were selling silver futures contracts, pushing prices down through derivatives markets, the bank's physical metals division was doing something else entirely: buying, quietly accumulating physical silver bars, storing them in vaults, building a position estimated by some analysts to exceed 800 million ounces, more physical silver than many countries hold in strategic reserves. Why would a commercial bank do this? Why would they suppress paper prices while accumulating physical metal? What did they see coming that others missed? The crisis that happened in late January was not random. Markets do not move like that without structure beneath the chaos. Silver's price collapsed violently. But while Western investors were selling in panic, someone was buying. Someone with deep pockets. Someone who understood that crashes create opportunities. Physical silver premiums in Asian markets spiked to 29% above spot price. That means buyers were paying 29% more than the crashing market price just to secure actual metal. Not paper contracts, not promises. Real silver. Why? What did they know? The Wednesday meeting in Washington was not about responding to a crash. It It was about preparing for what comes after. When governments move, they move on intelligence. And when banks position, they position on forecasts. When both happen simultaneously around the same commodity, smart observers pay attention, because the crash was not the story. The crash was the signal. What JP Morgan had been building in silence for years, what the government was now urgently assessing, that was the story. A story about strategic resources, institutional knowledge, and the gap between what markets show and what reality demands. The question was simple. What happens when the world's most sophisticated financial institution and the world's most powerful government both recognize the same truth about silver at the same time? The answer required looking deeper, into a strategy that began more than a decade ago, when almost no one was paying attention. In the summer of 2012, a curious thing happened that most people never noticed. JP Morgan received a phone call from regulators. The Commodity Futures Trading Commission had questions about silver. The bank paid a fine, not a small one, but something strange happened after that fine was paid. JP Morgan did not stop trading silver. They changed how they traded it. And that change would become one of the most fascinating financial maneuvers in modern banking history. To understand what they did, one must first understand a simple concept. There are two types of silver in the world: paper silver and physical silver. Paper silver exists on computer screens. Futures contracts, options, derivatives, promises to deliver metal at some future date. These contracts trade 24 hours a day across global exchanges, billions of dollars moving with each tick. But here is the critical detail. For every 100 ounces of paper silver traded, only 1 ounce of actual physical metal exists. The system runs on leverage, on confidence, on the belief that not everyone will demand delivery at once. Physical silver is different. It sits in vaults. It weighs on shelves. It cannot be created with a keystroke. It must be mined, refined, transported, stored. And there is only so much of it. Between 2013 and 2023, something unprecedented happened. While JP Morgan's trading desk was selling silver futures contracts, creating downward pressure on prices, their physical metals division was doing the opposite. They were backing up trucks to COMEX warehouses, taking delivery, actual bars, 1,000-ounce bars, week after week, month after month, year after year. Industry analysts watched the warehouse receipts. The data was public, so a few people understood what they were seeing. JP Morgan was not just buying silver, they were removing it from the market, taking it out of circulation, storing it in private vaults where no one could touch it. By some estimates, the bank accumulated more than 800 million ounces. To put that in perspective, that is more silver than the entire annual global mine production. More than many nations hold in reserves, all controlled by one institution. But why? Banks do not accumulate physical commodities for fun. Storage costs money, insurance costs money. Capital tied up in metal does not generate trading fees. So why would the most sophisticated financial institution in America spend years building this position? The answer lies in understanding something called institutional memory. In 2008, the financial system nearly collapsed. Lehman Brothers disappeared overnight. Bear Stearns vanished. AIG required a government bailout. JP Morgan survived. But the executives who lived through that crisis learned something. When systems break, paper promises become worthless. Only tangible assets hold value. Gold held value. Silver held value. Physical commodities could not be erased by accounting fraud or counterparty default. After 2008, JP Morgan's strategy shifted. They began building positions in hard assets, quietly, methodically, without fanfare. Silver was perfect for this strategy. It was cheap compared to gold. It had industrial demand that would only grow, and the market was small enough that a major institution could accumulate a dominant position without alarming regulators. But there was another calculation happening, a calculation that required looking 10 years into the future. JP Morgan's analysts could see what was coming. The world was going electric. Electric vehicles require silver for battery connections and charging systems. Solar panels need silver for conductivity. 5G infrastructure demands silver for signal processing. Every technological trend pointed toward massive future silver demand. Yet, global mine production was declining. Primary silver mines were becoming less profitable. Most silver comes as a byproduct of copper, lead, and zinc mining. When those industries slow down, silver supply contracts. The mathematics was simple. Demand rising, supply falling, deficit growing. Anyone who controlled physical silver would control a strategic bottleneck. By 2020, JP Morgan had positioned themselves perfectly. They held enough physical silver to influence global markets, enough to supply major industrial clients, enough to weather any shortage. And they had acquired most of it while prices were suppressed, while their own trading desk was selling futures contracts. This was not manipulation in the traditional sense. It was strategic positioning, using market structure to build a resource advantage. Then came January 2026. Silver's price exploded upward. Speculation drove it from stable levels to extraordinary heights. Madness, euphoria, and then collapse. But ask yourself this question. If you were J.P. Morgan, if you held 800 million ounces purchased at an average price below $20, if you watched the market spike and then crash, what would you do? Would you panic? Or would you recognize that even after the crash, prices were still multiples higher than your cost basis? Would you see crisis, or would you see validation? Validation that your decade-long strategy was correct. That silver was indeed strategically valuable. That physical metal would always find buyers. That scarcity was real. This is why the government meeting mattered. J.P. Morgan had spent 10 years proving a thesis. That silver was a strategic asset. That physical positions could be built quietly. That market volatility did not change underlying fundamentals. And now, with silver's crash, exposing supply chain vulnerabilities, with industrial demand continuing to grow, with geopolitical tensions rising, the United States government was suddenly very interested in understanding exactly what J.P. Morgan knew, and why they had spent a decade preparing for this moment. The bank had not been trading silver. They had been positioning for a future where silver was not just valuable, but essential. There is a room in the Pentagon that most people will never see. It has no windows, no nameplates on the door, just a security clearance requirement and a purpose. Inside that room, analysts track something called the National Defense Stockpile, materials deemed so critical to American security that the government maintains emergency reserves. Titanium for aircraft, tungsten for ammunition, rare earths for electronics, and silver, always silver, because without silver, modern warfare stops functioning. In February 2026, someone in that room noticed something alarming. The stockpile calculations no longer made sense, not because the numbers changed, but because the world around those numbers had shifted, and nobody had updated the assumptions. This is what triggered the urgent meeting. Let me explain what they saw. In 1985, the United States used approximately 40 million ounces of silver annually for defense applications, missile systems, radar equipment, communications infrastructure. The Pentagon kept a strategic reserve calculated to sustain operations for 3 years without new supply. 120 million ounces. Simple mathematics, but that was 1985. Today, a single Tomahawk cruise missile requires more silver than an entire weapon system did 4 decades ago. An F-35 fighter jet contains over 1,000 ounces of silver in its electronics and electrical systems. A nuclear submarine's command and control systems need 15,000 ounces. The AN/SPY-6 radar system on new destroyers uses more silver than the entire Pentagon stockpile from 1985. And this is just military applications. Modern defense depends on supply chains that did not exist 4 decades ago, commercial technology that cannot function without silver, GPS satellites, secure communications, cybersecurity hardware, all require silver. The analysts in that windowless room realized something terrifying. If global silver supply was disrupted, if prices became unstable, if foreign suppliers restricted exports, American defense readiness would collapse in months, not years. Months. This was not theoretical. In 2022, China restricted germanium and gallium exports, materials needed for semiconductors. Western manufacturers scrambled, prices spiked, production delays cascaded through supply chains. It took 18 months to find alternatives. Silver has no alternative. Not for high conductivity applications, not for military-grade reliability, not at scale. When the silver crisis happened in January 2026, it was not just a market event. It was a national security stress test, and the United States failed. Here is what happened behind closed doors. Defense contractors called the Pentagon. They had purchased silver futures contracts as price hedges. When the crash came, their counterparties demanded margin payments, cash, immediately, or the contracts would be liquidated. Some contractors could not meet the calls. Their hedges evaporated. Now they faced the spot market, where physical silver was trading at massive premiums, where delivery times had extended to 16 weeks, where suppliers were prioritizing customers by relationship, not price. Raytheon had a missile contract requiring delivery in 4 months. They needed 37,000 ounces of silver. Their supplier in Mexico said earliest delivery was 6 months. Lockheed Martin's F-35 production line slowed because connector manufacturers could not secure silver. Northrop Grumman delayed radar installations on 3 naval vessels, all because of silver. A commodity most Americans never think about was now bottlenecking the most advanced military in human history. But the military was just one dimension. The real problem was bigger, much bigger. The United States had committed to aggressive climate targets, net zero emissions by 2050. That required a complete transformation of the energy grid. Solar panels, wind turbines, battery storage, electric vehicle charging infrastructure. Every single component needed silver. The International Energy Agency had published projections. Meeting climate goals would require 250 million ounces of silver annually by 2030. Current annual global production was approximately 800 million ounces, and declining. Do the mathematics. Climate transition alone would consume 30% of global silver supply. Add industrial electronics, medical devices, water purification, telecommunications. The deficit was not theoretical. It was mathematical certainty. Someone in the Department of Energy ran a scenario analysis. What happens if silver supply cannot meet demand? The results were stark. Solar panel production would plateau. Electric vehicle costs would spike. Grid modernization would slow. Climate targets would become impossible. Not because of political will, not because of technology limitations, but because of one metal. This is what the government meeting was really about. Not responding to a price crash, but confronting a strategic reality. The United States had built its future on assumptions about commodity availability, assumptions that were no longer valid. During the meeting, someone presented a comparison. In the 1970s, OPEC's oil embargo taught America about energy dependence. It triggered the Strategic Petroleum Reserve. Policy changes, investment in alternatives, decades of strategic planning. Silver in 2026 was the same inflection point, except worse. Because oil has substitutes: coal, natural gas, nuclear, renewables. Silver has no substitute, not for its unique combination of conductivity, reflectivity, and malleability. The meeting participants reviewed supply chain data. Mexico provided 40% of U.S. silver imports. Political instability there could disrupt supply overnight. Peru provided another 30%. One mining strike, one environmental regulation, one government nationalization, and American industry would face immediate shortages. China controlled 60% of global silver refining capacity. They could restrict refined silver exports tomorrow. And the United States would have raw ore with no way to process it efficiently. This was the critical minerals calculus. Silver was not just a commodity, it was a strategic vulnerability, a single point of failure across multiple critical sectors: defense, technology, energy, manufacturing, all dependent on a metal that America did not control, could not produce domestically in sufficient quantities, and had no viable substitute for. The analysts presented three scenarios. Scenario 1, current trajectory: demand outpaces supply by 2028, prices spike again, industries face allocation shortages, strategic projects delay indefinitely. Scenario 2, supply disruption: major producing country restricts exports, United States faces immediate shortages, military readiness compromised, industrial production halts. Scenario 3, strategic action: government intervention, stockpile building, domestic production incentives, long-term supply agreements. The third scenario required immediate action and significant capital. It also required understanding what major institutions were already doing, which brought the discussion back to J.P. Morgan. The bank had spent 10 years building a position that the government was now realizing it needed. 800 million ounces, acquired below market prices, stored strategically, available for allocation. Was this coincidence? Or had J.P. Morgan seen the same data, run the same calculations, and positioned ahead of policy realization? And if a private bank understood this strategic reality a decade ago, what did that say about government preparedness? There's a concept in intelligence analysis called convergence. It happens when multiple independent actors reach the same conclusion simultaneously, not through coordination, but through analyzing identical data. When convergence happens, it signals something profound. The underlying reality has become undeniable. February 2026 represented a convergence moment. J.P. Morgan held a decade-long physical silver position. The United States government convened urgent meetings on critical minerals. Silver crashed 41% in 72 hours, and someone bought 127 million ounces during the panic. These were not random events. They were data points forming a pattern that revealed a fundamental market transformation happening in real time. Let us start with the timing. J.P. Morgan began accumulating silver in 2012, 14 years ago. What did they know then that others are only discovering now? Their analysts would have seen the same projections: smartphone adoption accelerating globally, solar energy becoming cost competitive, electric vehicle technology advancing, 5G infrastructure requirements. Every trend pointed toward exponential growth in silver demand. But there was something else, something more important than demand projections. They understood market structure, the gap between paper and physical silver. In commodity markets, futures contracts trade at multiples of physical supply. This works fine when markets are stable, when participants trust the system, when delivery is theoretical. But what happens when confidence breaks? What happens when buyers demand physical delivery instead of paper settlement? January 2026 answered that question. When silver crashed from elevated levels to $72, The paper market showed one story: prices collapsing, panic selling, market destruction. But the physical market told a different story entirely. In Shanghai, physical silver traded at a 29% premium over spot price. In Singapore, dealers could not source inventory. In London, the premium for immediate delivery hit levels not seen since the 1980s. This was not normal market behavior. This was structural dislocation. The paper price said silver was worthless. The physical market said silver was scarce. Both could not be true simultaneously, unless the market itself was broken. Here is what was actually happening. The January spike brought in speculators, retail investors, momentum traders, people buying silver futures contracts with leverage. They did not want silver. They wanted price exposure. When prices started falling, they sold immediately. Margin calls forced liquidation. Algorithms triggered stop losses. The paper market collapsed under its own weight. But industrial buyers saw something different. They needed actual silver for production, not next month, not next quarter, now. They watched paper prices crash and did something counterintuitive. They paid premiums, huge premiums, just to secure physical metal, because they understood what speculators did not. Paper prices were temporary. Physical scarcity was permanent. This is where JP Morgan's strategy becomes crystal clear. For 10 years, they accumulated physical silver while paper prices were suppressed. They built a position when everyone else was trading contracts. When the dislocation came, when paper and physical markets diverged, JP Morgan held the asset that mattered. Not promises, not derivatives, actual metal. The government meeting was essentially asking one question. How did a private bank understand this before we did? But there was a deeper question. What happens next? The crash exposed something regulators could no longer ignore. The silver market was not functioning properly. Price discovery was broken. Physical supply was disconnected from paper trading, and strategic industries were vulnerable. Several outcomes became possible. First possibility: government intervention in silver markets, new regulations on derivatives, position limits for commercial banks, mandatory physical backing for futures contracts. This would fundamentally change market structure. It would also validate JP Morgan's physical accumulation strategy. Second possibility: creation of a strategic silver reserve, similar to the strategic petroleum reserve. Government purchasing physical silver for national security, guaranteeing supply for defense contractors, providing stability for industrial planning. This would require billions in capital. And guess who holds the largest available supply? Third possibility: domestic production incentives, subsidies for American silver mining, tax breaks for refining capacity, long-term purchase agreements to guarantee profitability. This would take years to implement. Meanwhile, demand continues growing. Each scenario had implications, but all three scenarios shared one common element. Physical silver became more valuable, not less. The crash was not destruction, it was validation. Validation that paper markets could not sustain disconnection from physical reality. Validation that strategic resources require strategic planning. Validation that institutions which understood this early would benefit. For business leaders and entrepreneurs watching this unfold, the lessons were clear. First lesson: market price does not always reflect underlying value. Silver crashed 41%. But industrial demand did not decrease 41%. Defense needs did not disappear. Technology requirements did not vanish. Price and value had separated. Understanding the difference was critical. Second lesson: strategic positioning requires long-term thinking. JP Morgan spent 10 years building their position. Not 10 days, not 10 months, 10 years. They absorbed criticism. They paid carrying costs. They waited while others chased short-term gains. And when the dislocation came, they were positioned perfectly. Third lesson: government policy follows market reality. The urgent meeting happened after the crash, not before. Institutions that anticipate policy shifts, that position ahead of government action, those institutions capture extraordinary value. Fourth lesson: physical assets behave differently than financial assets during stress. When markets panic, paper burns, contracts liquidate, promises default. But physical commodities do not disappear. They become more valuable because scarcity becomes obvious. The convergence of February 2026 was not about silver's price. It was about silver's role, from speculative commodity to strategic necessity, from traded instrument to national security concern, from market opportunity to policy priority. JP Morgan understood this transformation was coming. The United States government was now confronting it. Industrial buyers were experiencing it, and anyone paying attention could see it. The crash was the signal. The urgent meeting was confirmation. The physical premiums were proof. What comes next depends on one question. Will other institutions and governments learn what JP Morgan learned a decade ago? Or will they continue treating silver as just another commodity until scarcity makes that position untenable The answer will determine who thrives and who scrambles for supply. In a world where strategic resources have become strategic weapons, understanding this convergence is not optional, it is essential.